Hello there and welcome to the last casual valuation of the year. We have Tesla, the company that has been discussed the most during 2022. And it seems as everyone has an opinion about the company, whether it is overvalued or undervalued, whether it is going to become the biggest company in the world or if the share price is going to continue going down to $40, $50, $60 a share. Now we're going to take a look at a lot of stuff. We're going to take a look at how it compares to other car manufacturers, and apologies upfront for the length of the video. There's a lot that I believe is relevant to have a better understanding of Tesla. And of course, the focus will be on fundamentals of understanding what drives the value of Tesla. By the end of this video, you will hopefully have all the tools to value Tesla on your own, but also understand what are the most important pieces and what are the assumptions that you need to make to value Tesla. So as you can see, the share price is quite volatile. It's down actually over 70% in 2022. But if we zoom out, if we take a look at the last 5 years, it's up almost 500%. So let's get started. The first question, as always, is what is Tesla? My definition is it is a car company with big dreams and impressive technology. Now, regardless what opinion you have about Tesla, about the future, there is no doubt that it has been a disruptor of the industry over the last decade. Not only when it comes to the electric vehicles, but also the dream that was out there about the full self-driving capability. At the moment, Tesla has two reporting segments. The first one is automotive, that contributes the most of the revenue and even more when it comes to the gross profit. And the second segment, energy generation and storage, definitely an important one. However, if we take a look at the value that it brings to Tesla, at the moment, it's not that significant. So if we focus on the automotive segment, basically there are two main inputs that we need to value that. The first one is the number of cars sold annually. How many cars do we expect that Tesla will be selling 2, 5, 10 years from now? And also, what are the margins that Tesla will be able to keep per car? So we will come to that in a bit. We're going to take a look at a lot of basically data points that compare Tesla to other car companies and basically what we can expect from Tesla in the future. Now, if we take a look at the big dreams, the first one, the FSD, is something that is slowly becoming a reality. Tesla, in my opinion, is still the company that is doing the best in that case. It has the most data, but there's no doubt the other car companies are catching up. And of course, the dream is that not only it's used for personal use, but that eventually it unlocks the idea of having robotaxis or driverless taxis. Now, the second big dream is one that I don't really believe in, and that is the statement of Elon Musk that they will be selling 20 million cars annually by 2030. I could be wrong, but of course, Elon could be wrong as well. 20 million cars at the moment, Tesla sells, at least for 2022, it's expected around 1.4 million. So a huge increase, but of course, 2030 is also a long way in the future. Then we have Optimus, the humanoid robot that is expected to cost around $20,000 and to be on sale by 2027. This was revealed during the latest AI day, and the engineers who are not working for Tesla have been impressed by the progress that was made in a short period of time, but not impressed by where the robot is at the moment and basically what it is capable of doing. So there's still a long way there to make sure that Optimus is adding value and is worth the price. And lastly, this is again a forecast, an estimate by Elon Musk that the energy generation and storage segment, the one that is insignificant at the moment, is going to be worth as much as the automotive segment. So there's a long way for that to be true. There's a lot of research to be done, a lot of products to be developed that are actually valuable. But of course, we have the storyteller, and we have to start by addressing a little bit his impact on the share price. And basically, after this slide, we're not going to focus on Elon Musk. We're only going to focus on the fundamentals of the company. Now, what I have noted here in the title is one is greater than 110,000, and that is because his tweets impact the share price more than basically the work that 110,000 employees at Tesla are doing. More recently, he's moved not only from sharing his views about Tesla in the future, but more political views and opinions that it seemed that converted Elon Musk from being seen as one of the most valuable assets of Tesla to potentially a liability, and basically maybe turning some customers away from Tesla or some potential customers. So hopefully by the end of this video, we are going to answer how realistic his predictions are, but we're not going to address, we're not going to focus on Elon Musk per se anymore. So his prediction is that Tesla's valuation will reach 4.5 trillion in the next few years. I don't think that will be the case, but okay. We're going to take a look at the fundamentals. If we zoom out, one of the inputs that we need is number of cars that Tesla will sell annually. So let's take a look at how many cars are being sold worldwide every year. Obviously, the number is fluctuating, but it's quite clear that there is some stable level that we could agree that's around 70 million cars a year. So Tesla in 2022 is expected to sell 1.4 million, representing around 2% share. If they are to sell 20 million, that represents 28.5% share. That's basically over a quarter of the cars sold to be Tesla. Is it realistic? I'll let you be the judge, but this is basically how the prediction translates in a percentage of market share. Let's take a look at the capacity. This is very important as, of course, if there's no capacity, it doesn't make sense to discuss the forecast, or basically what we need to understand is how much it would cost Tesla to increase the capacity. At the moment, they can produce 1.9 million cars a year. And this is, of course, coming from their annual report. And if you take a look at their outlook when it comes to the volume, we plan to grow our manufacturing capacity as quickly as possible. Over a multi-year horizon, we expect to achieve 50% average annual growth in vehicle deliveries. The rate of growth will depend on our equipment capacity, factory uptime, operational efficiency, and the capacity and stability of the supply chain. All right, that's a bold statement, 50% annual growth, 1.9. That's, of course, the capacity. That doesn't represent the deliveries. The deliveries, again, are kind of closer to 1.4 million for 2022. But let's take a look at their latest, or one of the latest factories, the Berlin factory. It cost them $5 billion to get it up and running, and the production is about 250,000 cars. So if we divide the two, basically, it costs them $20,000. That's the investment required to increase the car capacity by 1 unit. So if, for example, in the future, we expect that Tesla's capacity will increase by 5 million, so instead of being able to manufacture 2 million cars to 7 million cars, basically that 5 million additional capacity would require about 100 billion in capital expenditure. This is something that we need to keep in mind, because when we're making assumptions, we have to keep in mind also the capex required. Now let's take a look at the historical financial performance. The gross margin did increase over time, and it is at a very high level for a car company. But that is partly because, of course, the manufacturing process that Tesla has, but also the unconventional distribution model that bypasses dealerships. So they're not selling through dealerships. That means there's no third party that keeps a small cut. The whole gross margin comes basically back to Tesla. The growth, in my opinion, has been nothing but impressive. Since 2018, a bit over 20 billion in sales. Now 75. Of course, if we take a look at 2022, it will be probably closer to 80 billion, if not above. And the vehicles, of course, the deliveries, it also moves in the same pace. So let's take a look at the competitive landscape. This is something that is very important, and this is normally when the criticism of Tesla starts. And especially the criticism is when Tesla is being compared to Toyota. Toyota is selling about 10 million cars a year, while Tesla is selling 1.4 for 2022. So this is an estimate, but just stick with the numbers for now. So we have Tesla with 1.4, Toyota with 10 million. Tesla is bringing a lot less revenue, but the market cap is much, much higher. Again, 1.4 million versus 10 million cars. This is, again, where the criticism starts. And then we look into the PE ratio, and it seems that Tesla's PE is basically 7 times higher than the average competitor PE. But if we only look at this, this doesn't show the full picture. We need to take a look into 3 other segments. We need to take a look at the profitability, we need to take a look at the debt, and we need to take a look at the future growth and the return on invested capital. So let's start by looking at the profitability, right? So as mentioned, Tesla's gross margins are, as you can see, much higher than any of the competitors. Again, on one side, we have the bypassing of dealerships, and I think on the other side, they had the opportunity to build factories from scratch that are perfectly suited for EV products, for EV cars, compared to a lot of other companies that had to make tweaks and further investments to repurpose the factories from traditional cars now to EVs. On the other side, if we take a look at the operating expenses, well, it's a little bit lower than most, but there are also some companies that have even lower operating expenses. So what we have as other or these operating expenses, we have the selling, general and administrative expenses, we have the R&D, and of course, Tesla famously does not spend money on marketing or advertising. It is funny that Tesla bought Twitter, who's solely depending on that, but of course, that's a story for a different time. So it's obvious that Tesla has the highest operating margins by far comparing to the traditional, the big name car companies. And I've only excluded, I think, Porsche and Ferrari because they're kind of targeting only a small portion of the population. They're not really a mass market, a company that targets almost everyone. They're really focused on a certain niche of customers. So they have the highest operating margin. But take a look at the comparison again if we take a look at Toyota. Even though they're selling a lot less cars, look at the operating profit, 12.5 billion versus 16.5 billion. So they have a third of the revenue, but almost the same operating profit with a lot less cars. So there is something here that we need to better understand. Now let's take a look at debt. And I took a bit of a different route here. I take a look, of course, at the market cap. So they're sorted based on the market cap. I took the net debt, or basically what is the net debt position, taking all the cash and the debt together. And as you can see, Tesla has more cash than that. And then I just combine the two in a simple way just to get an estimate of the enterprise value of basically that is how much one should pay to buy the company debt-free. This is an estimate because it's not 100% accurate. I don't have, for example, the minority interest into account, but that's not that significant for these kind of companies. So if you are to buy Tesla without that, you would be paying 366.5 billion. For Toyota, it's 332.2 billion. So that now this difference isn't that high because Toyota has a lot of debt. Volkswagen, Mercedes, BMW, General Motors. Take a look at the debt that they have. So if we take a look at that and if we kind of combine that together, the market cap plus the net debt gives a different picture. So what I'm doing then is I'm comparing how much one would have to pay to buy the company debt-free and what is the profit from its operations, from the operations of each company. And now the ratio, as you can see, Tesla is not, if I go back to the previous one, the PE was more than 7 times higher. Now it's less than 3 times higher. But why is this important? It's important because debt isn't free. If we're in recession, which is what is expected to be even more stronger in the coming period, if the number of units sold decreases, or if companies have to lower the price of the cars, basically that means there's less profit. But that doesn't care if you're profitable. You have to pay it back. You have to pay it with interest. So having debt is something that is, of course, a lot of basically represents a big burden, especially on these large companies. And if anything, high leverage combined with unprofitable business is pretty much the secret formula to bankruptcy. So if we take a look at Toyota now, it needs 9 years of operating profit to cover its net debt, so to pay back the net debt. On the other side, the ratio isn't that far off, so Tesla and Toyota. But there's still one more portion, one more segment that we'll need to look into, and that is the growth and the return on invested capital. Why is this important? Well, of course, the growth is one of the main factors for estimating the future value. Tesla is expected to grow at 45% for the next 12 months, Toyota at 14.5%. BYD, very high growth, but the other car companies have growth expected below 10%. Now, why is the return on invested capital important? That is pretty much it shows how well the capital is being invested and the returns that it brings in. But not only that, Tesla is investing in all kinds of other side projects. We have solar, that's not really profitable yet. We have Optimus, that has been And who knows what will come in the next decade. And in my opinion, they have a startup culture. They're more innovative. They can afford, because they have no debt, to take more risks. And again, the fact that they could build production facilities from scratch is also an advantage that other car companies, the old school one, didn't have. So if we take this into account, now it's the picture between, or at least the comparison between Tesla and Toyota, it's a little bit different. Again, if I go back to the previous slide, this ratio, if the prices remain the same of the companies or the market caps, would look much different a year from now when the operating profit of Tesla grows significantly and the one from Toyota grows a little bit, but nothing too significant. Now, before we move into the valuation, let's take a look at Tesla. We already know that they have a good position when it comes to cash, for 20 billion, 21 billion, and of course we have the debt on the other side that leads to the net debt being negative, so they have more cash than debt. They have been growing organically, so they're not growing through acquisitions, and the balance sheet has increased significantly, but of course on one side they have lots of investments in manufacturing facilities and to keep basically to meet the demand, they need to keep more inventory as well. If we take a look at the gross property, plant and equipment, 43.8 billion. If we divide that by the 1.9 million capacity that they have at the moment to car production in cars, that's roughly 23,000 a car. That's not far from where we got with a simple exercise using only the Berlin factory. But of course, this property, plant and equipment is also used for all kinds of other activities, including R&D, including the normal supporting functions such as finance and legal and well, not that much marketing maybe, but HR and so on. Now, on the other side, if we take a look at liabilities and equity, they have two lines here, unearned revenue current and unearned revenue non-current. And basically those are deposits from the customers for kind of a prepayments on orders for cars and or maybe all kinds of vehicles that are yet to be delivered. So they have the cash, but they still need to deliver. So at the end, I'm reducing these amounts from the cash positions because, well, it's not earned revenue, and otherwise I would be double counting. And that is at incredibly low level. They had significant debt positions in the past, especially because they weren't really profitable at that time, back in 2018. But now the profitability is up significantly and they used all the excess cash to pay down the debt. So if we're in a recession and if it lasts for a couple of years, Tesla is one of the companies that's best suited to withstand the difficult times. So what are the analysts forecasting? 2022, 54% growth in revenue. Next year, 37, 38%. And if we take a look at the margins, they're expecting that the margins grow over time. So 17, 18, 19%. What are my assumptions? Well, I have a couple of assumptions that differ from the average analyst estimates. On one side, I have a bit lower revenue forecast for the next year, 35%, then by year 5 to decrease to 20%, then by year 10 to decrease to 5%. Operating margin, if we're in recession and they have to maybe lower prices and have lower margins, basically for the next 2 years, I'm lowering their operating margin to 10% and then slowly increase to 16 and then to 18%. So I will eventually get to where the analysts are basically forecasting, but not in 2 years, or in a bit longer periods. And I won't go above 18%. This is, again, me being what I believe is conservative, but I could be wrong with all these assumptions. And then when it comes to the reinvestment for the next 2 years, I don't expect them to invest a lot because, again, if they're not bringing a lot of cash, I would not expect them to increase the capacity significantly. But at the moment, they have a lot of unused capacity. Again, 1.9 million cars capacity, 1.4 million produced. There is room there already. Now, there are many segments, a lot of products within Tesla, some that have been, again, in production, such as the vehicles, and some that are the big dreams. My estimate is that automotive segment, or this is also an assumption, will account for 90% or even more of Tesla's value. So I'm discounting all the future cash flows with a discount rate on 9.5%. So let's take a look at how the numbers roll forward. First, we start with the revenue growth, and by year 10, we have a 431% increase. At that time, basically, Tesla will be selling about 6 million cars a year. So not the 20 million estimate that I believe is crazy, but that would represent 8.6% market share. To get there, right? So from 2 million capacity to 6 million, they would need to invest 20,000 for each, or to add additional capacity to produce a car. 4 million times 20,000, that's 80 billion. That is the investment required to get there, and that is, of course, in the additional reinvestment column. If this is to happen, and you'll see that the next couple of years, I have much lower free cash flow just because I expect difficult times, you'll notice that the company will generate about 100 billion in free cash flow over the next 10 years, and majority of the value comes when they've reached more or less the peak when it comes to the number of cars sold per year and their market share, which I don't think will be in 2 years, but also when it happens, it won't be at 20 million cars a year. So the present value of the terminal value is closer to 450 billion, and that brings the value of the business at close to 562 billion. Of course, we need to make some adjustments for the cash that they have, the non-operating assets and liabilities, including the unearned revenue. We need to subtract the equity options, and we get to the value of the company of the equity being worth 563.5 billion, or per share $980. The price at the moment is close to $113 a share, and if my assumptions are correct, that offers about 14% internal rate of return over the coming period. But I could be wrong. I could be wrong about all of the assumptions that I've made. So it's obvious that, as mentioned at the beginning, there are two most important inputs. And the first one is how many cars can they sell in a year? And the second one is the margin of every car. So you'll notice that what I've marked here are my assumptions when it comes to the revenue and the margins. But if you believe that at their peak, for example, 10 years from now, Tesla will be selling 4.5 million cars or 3.5 million cars. Again, at the moment, they're at 1.4 million. You can use those assumptions and kind of see where the valuation falls. These prices are per share, and the operating margin, analysts are forecasting even above 20%, keeping it at 18%, but I could be wrong in both sides. Now, Elon's scenario, and this is the last time that I think this is something that's worth mentioning. If basically Tesla grows at 35% annually for the next 10 years, that's where they're going to reach the 20 million cars sold annually. And in this case, I'm not even taking the energy or the energy production and storage segment at all, which if it's expected to be equally valuable, then basically the share price today, the fair value would be $1,000. Is it? I mean, I'm not going to even discuss that. I'll let you decide whether that makes sense or not. But this is at least my take. I hope that you enjoyed the video. Again, I apologize that it's been probably over 20 minutes, but these are all, in my opinion, relevant information to understand Tesla. So starting from the fundamentals, the comparisons against other car companies, and also how much they need to invest to increase the capacity over time. First, the most important question that is to be answered over time is there going to be demand for example, 3.5 million, 4.5 million, 6 or 20 million cars in 10 years' time? But that's something that is yet to be seen. And there's also one last thing. I know that recently it was announced that you can download and play games in Tesla. So I can also see that at some point, the operating system of Tesla, there's kind of an app store where you can buy games or buy any kinds of applications, and Tesla would get a small cut of that. Basically, that is a very high margin segment if it becomes a significant portion, but I cannot imagine that contributes to more than a couple of percent of the total revenue. That would be all. I hope that you enjoyed this video, and as always, see you in the next one.